Hello and welcome to the programme. I'm Owen Fairclough. My guest today has witnessed the rise of not just one, but two continents economically. Shanta Devarajan is the World Bank's chief economist for Africa, and before that was the chief economist for South Asia. Shanta Devarajan, many thanks for joining us. We're here in Gabon, in the open air. We are seeing a radical transformation of this continent. In Gabon, this is my first time here. I see Chinese workers everywhere. We're seeing billions of dollars of investment from countries like China that is being mirrored across the continent. Sum up for us, if you can, what's happening here, because you get the sense we are witnessing a really important moment in economic history.
It's an important moment that has been building up for the last 10 to 15 years. Growth in Africa since the late 1990s has been about 5%, accelerating to about 6% just before the global economic crisis. And the important thing is, while much of this growth was fueled by high commodity prices, it also was driven by the improvements in macroeconomic policies. So in one sense, I think that's the transformation that is happening in Africa, is that economic policies across the board, from Gabon to Kenya to Sudan to Zambia, have improved to the point where these countries can make better use of the high commodity prices. And that's why you're seeing this private investment. Private capital flows to Africa are now over $50 billion. That's more than foreign aid. And you're seeing the Chinese workers and the investors at the New York Forum as well, who are very anxious to make money in Africa, because if the policy framework is improved, you can actually invest in the continent.
There seems to be here in Gabon a discussion. We hear a lot about an African business model, but it seems to me very difficult to come up with this when you've got a continent that's got, more than 50 countries in it. Is there really such a thing as an African business model?
No, I think there's each country has its own model. There are some common features. I think some of the common features were the fact that the continent as a whole suffered from very low economic growth for the previous 20 to 30 years, and people felt that there were some syndromes that were driving that low growth, much of which having to do with very poor governance. And that led to poor policies, which in turn kept the growth rates low and kept the population in poverty. As we are emerging from that, though, countries are approaching it very differently. The one common feature, I would say, is that they are acknowledging that they have to compete in the global marketplace. So countries are opening up their trade, their finance, their investment to foreign investors in such a way that you can improve the quality of life for their own people.
You mentioned governance. Another word we hear is transparency as well, and surely that's a problem, because it's easy to overstate the potential of Africa, or perhaps the potential in terms of drawing foreign investment. A lot of people, retail investors for example, are going to find it very difficult to invest in a country they think is still quite dangerous. How do we overcome those kind of perceptions?
No, it's more than transparency. I think governance is about accountability. It's about people being able to hold their governments accountable. And I think that's what investors are looking for. The investors are looking for governments, not necessarily strong governments that may not be accountable to their people, and it could be even governments that are a little bit chaotic, but yet maintain that accountability. I mean, I take a country like Kenya, for instance. I mean, Kenya, there's quite a lot of chaos, especially if you've been driving in traffic in Nairobi. But at the same time, you have a sense, especially with the new constitution, that the government has opened itself up to its people. And the new constitution also guarantees decentralization to the county level, where now the local governments will be accountable to their people. That's, I think, the signs that we should be looking for.
Kenya is a good example. Kenya is a good example of perhaps an economy that's towards the higher end of the scale, if you like. If I took an example of a country like Congo, when you look at World Bank, ease of doing business surveys and so on, I mean, some of these countries are some of the most difficult places in the world to do business. Investors are going to see those kind of numbers, those kind of reports, and think, this is not quite for me just yet.
Well, I assume you mean DR Congo, Democratic Republic of Congo. Yes, there's no question that if you look at the national averages, it's a very weak, a difficult place to do business, as the indicators show. At the same time, there are individual places where you can make a lot of money. And that's why Congo is getting investments. The Chinese have invested billions of dollars in Congo. Congo is rich in minerals, And those minerals can be valuable both to the Congolese and to the outside world. And if you, with some investments that protect it from some of the chaos going on elsewhere in the country, can be highly lucrative.
You mentioned minerals. One of the problems traditionally with Africa as a continent is we talk about an area of the world which is very rich. We hear about green gold, the value of the fauna, the value of the minerals, the value of the natural resources. And yet one of the problems traditionally in Africa is trying to transform that into some sort of added value, to have these countries produce finished products. That surely remains a problem when you're talking about trying to get investment, you're talking about trying to get African countries to basically make things for themselves. Are we not a long way from that sort of situation where countries can openly trade with each other, trade finished goods?
Well, I think there's a broader problem, not related to natural resources per se, which is that Africa has yet to develop a light manufacturing, a labor-intensive manufacturing base. I mean, you think about even the resource-poor, resource-scarce countries like Kenya, you should be seeing thousands of factories employing millions of workers, and yet you see only a handful. And that's true also, maybe even more so, in our mineral-rich countries. But the reason there is not necessarily the minerals. It has to do with infrastructure. It has to do with the skill base of the labor force. You know, it's not unrelated that 70 to 80% of Africans earn their living in the informal sector, in smallholder farms and in household enterprises, and earning very little at a very low pace. And these are tiny, tiny enterprises. The challenge is, how do you scale those up? And I think we need to develop the skills of the entrepreneurs, we need to teach them about business practices, and we need to improve the infrastructure.
Is this about giving them some sort of international standard or to play against?
I think it's very more basic than that. We've done an experiment, for instance, in Ghana, where we took these informal entrepreneurs and taught them bookkeeping, just one thing. And when you teach them bookkeeping, they can know how to keep track of their assets. And that enables them to access finance. The bank will give them a loan if they can show what assets they have as collateral. And this has led to an expansion of their business. Then they can hire 5 people, buy a machine, and actually grow their industry.
And it's a pivotal moment. I think you said that China is becoming a more expensive place to manufacture and could stand to lose potentially tens of millions of jobs there in the next 10, 20 years or so. Those are jobs that could potentially come to Africa.
Absolutely. China is expected to shed about 85 million jobs. Now, even if we get half of that in Africa, that could double the formal sector labor force on the continent. And, you know, take the example of Ethiopia. In Ethiopia, there's a potential for garments and footwear. Right now, the best garment and footwear manufacturers in Ethiopia are as competitive as Vietnam. If you can get the others in Ethiopia up to that level, you could take Ethiopia's light manufacturing sector from 9,000 jobs, which is what it is now, to 1 million jobs, which is what it is in Vietnam. Comparing Africa to the Eurozone, we're in a rather strange position now where some of these African economies have probably got some good lessons in terms of fiscal governance, in terms of managing their debt to GDP ratios and so on. What kind of lessons do you see some African countries giving Europe with this unprecedented economic crisis that we're seeing in Europe? Well, that's an interesting question. I've been thinking about that because Africa went through a transformation that Europe is trying to go through now, which is the HIPC initiative, the debt relief initiative of the early 2000s, when the debt was forgiven for most of all but 2 or 3 countries, but it was accompanied by an improvement in the medium to long-term economic strategy. These poverty reduction strategy papers. It wasn't a blanket austerity program, shall we say. It was a medium-term program that involved fiscal prudence, of course, because without fiscal prudence, you could have another debt crisis 10 years later. But the important thing is this program was owned by the countries themselves. It wasn't forced on them by outside players, and they have stuck to it. Think about the fact that during the global economic crisis of 2008-9, when some of the European countries and the United States were increasing their fiscal deficits, African governments continued with prudent macroeconomic policies. Some of them ran small fiscal deficits as an expansionary program during a global recession, but others, like Ghana, actually cut their deficit during the global economic recession.
Just briefly for us, could it all go wrong for Africa, and if so, how could it go wrong in terms of economic development?
Well, it could go wrong in a number of ways. One is if the European crisis leads to another massive global recession, because then we will see a decline in commodity prices, as we saw in 2008-9, and then growth can fall from 5.5% to 2%. And remember that 2% growth, GDP growth in Africa, means negative per capita growth. And so the poorest continent in the world will become even poorer. This could be vastly devastating.
So it is finally poised in many ways, although we're at a pivotal moment, as we say, there is still a lot that hangs in the balance.
There's a lot that hangs in the balance, but I'm confident that given that African governments have shown the ability to maintain prudent policies, that we can withstand and Africa will continue to be resilient during these crises.
Okay, we'll have to leave it there. Shanta Devarajan from the World Bank, many thanks indeed for joining us. That's it for this edition of the programme. There's more news coming up here on France 24.